뉴욕나우. 안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우. 오늘은 스티븐로치 예일대 교수와의 인터뷰를 준비했습니다. 로치 교수는 미국 투자은행인 모건스탠리에서 30년 이상 근무한 월가 출신의 경제학자입니다. 닥터둠으로 유명한 루비니 교수와 함께 비관론자로 손꼽히죠. 1970년대에는 미국 페드에서 일한 경험이 있고요. 이후에는 모건스탠리에서 수석 이코노미스트로 근무했습니다. 2005년에는 부동산 시장 과열을 경고해서 주목을 받기도 했었습니다. 모건스탠리 아시아 회장으로 홍콩에서 일한 적도 있어서 한국, 중국 등 아시아 국가에 대한 이해도도 깊은 편입니다. 2012년 월가를 떠났고 현재까지 예일대 교수로 재직하고 있습니다. 로치 교수는 그간 페드의 금리 인하 정책에 대해서 날을 세워왔는데요. 오늘은 현재 시장에서 관심을 끌고 있는 인플레이션, 금리 인상에 대한 의견과 함께 미국 경제 그리고 달러와 가치 등에 대해서 이야기 나눠보겠습니다.
Well, I think the debate is over. We have had a much sharper increase in inflation than certainly the Fed and most forecasters were expecting. It's likely to last longer than most were expecting, in large part because of the broken supply chains that are affecting costs and deliveries across the board in the US and the global economy, also occurring in the face of what has been an extraordinary post-COVID lockdown snapback in aggregate demand. So I don't know if we're going to go a good deal higher than 6%. We may or we may not, depending on how things play out from here. But this is well in excess of what the Fed had expected. You know, it raises the distinct possibility, in my view, that the Federal Reserve Board is missing a major upsurge in inflation, and eventually we'll have to tighten a good deal more than it currently expects to bring this inflation problem under control. Well, stagflation implies not just an outbreak of inflation, which we've already had, but slower economic growth. There's been some slowing after the very, very sharp increases in the aftermath of the lifting of the lockdown. But you know, it remains to be seen if the economy is going to weaken further, especially with all this fiscal stimulus now coming on stream as the Biden administration succeeds in enacting its stimulus packages. So I'm not certain that there'll be a replay of what we saw in the late 70s that we dubbed stagflation. If the Fed fails to address the inflation problem, we certainly could have that, and that the burden addressing that is up to the monetary authority. Well, I think the whole approach that they're using right now is wrong and it's backward. The Fed believes that since it had a two-step process to address the crisis, both the global financial crisis and the COVID crisis, which was first cutting interest rates to zero and then expanding the balance sheet, that it needs to mechanistically reverse the same approach and deal with the balance sheet first through tapering and then only belatedly adjusting interest rates. I think that approach is wrong. I think the Fed should be moving up interest rates first and worrying about the balance sheet later. All this discussion about tapering is missing the biggest challenge that the central bank faces, which is that the level of real interest rates is far too low. Right now, it's negative, given the spike in the CPI. And if there's anything we learned from the supply shocks of the early 1970s, and I was working at the Federal Reserve back then, is that negative real interest rates in the face of supply shocks that give rise to higher inflation is a recipe for a major mistake. And so tapering is the wrong issue right now for the central bank to address. Well, I would like to see it begin immediately, but the markets are not pricing that in till late 2022 or early 2023. I think the longer inflation remains elevated, the greater the pressure will be on the Fed to accelerate this move in the federal funds rate. Right now, they're giving no indication that they're willing to do that, and I think that's a big mistake. I think the federal funds rate right now should be at least 1 to 2% in nominal terms, which would still leave it negative in real terms, but it would represent a significant increase from the zero bound that the Fed is right now. And I think it should move up higher to at least 3% in 2022. And again, this is far in excess of what most people think, but it reflects my view that this is a persistent overshoot of inflation, not transitory, to limit the inflationary consequences of this supply-demand imbalance in the U.S. and the global economy. A more aggressive stance on interest rates is required. There's never a loss of risk factors in terms of assessing the outlook for the market. The ones that matter the most are the ones that are not talked about today. The markets have already been addressing many of the issues you raised, from China to supply chains to climate change and things like this. So we have to think out of the box and try to figure out what might take the market by surprise. And I don't have a crystal ball to answer that. I'm particularly concerned about the conflict between the United States and China. Just finished writing a new book on that, so that is very much on my mind. And I think that is an issue that will continue to have an impact on the world economic outlook and on global financial markets over the next several years. Well, China is not retreating. China is addressing a lot of the challenges that it faces both internally and externally through conflict, predominantly with the United States on issues of trade, technology, and geostrategic security issues. But China is making an effort to develop its own sources of homegrown or indigenous innovation. It's trying to stimulate internal private consumption. It's making an effort to reduce its reliance or its dependence on an inhospitable climate in the West, especially the United States. But if anything, this would increase China's strength and power as a leading engine of support to the global economy. And it remains to be seen how the United States would take that, whether it would be taken as a threat or as an added source of support to the world. Well, I do, and I've just written a book about that, and I can't really tell you exactly what's in it until the book comes out, but suffice it to say that the current framework that both countries have adopted, the so-called Phase 1 agreement to resolve the trade tensions, has not worked, and it cannot work. It's the wrong approach to address the economic imbalances of either nation, especially the United States. Last year, the United States had trade deficits with 96 countries. China was the biggest, although its share has come down significantly because of the tariffs that the Trump administration imposed on China. But this has not reduced the overall U.S. trade deficit. The overall U.S. trade deficit actually widened dramatically further last year. And so the Chinese piece went to many other producers around the world, like Mexico and Vietnam and Singapore, South Korea, and others who's in general are higher cost producers than China. And this puts a tax along with the tariffs on American companies and American consumers. So that approach, the phase one approach, is a recipe for failure, and it has in fact backfired and failed. So we need a new approach, and that approach is the subject of my new book. Well, the one area that has me concerned, and I've been an optimist on China for a long time, is this new approach that the Chinese government adopted in recent months, tightening regulations on large platform internet companies, and in going after some of the more difficult social habits. It's younger generation from video gaming and music, but also going after some things like private tutoring and business entertainment and the like. And then you couple that with the so-called common prosperity campaign of Xi Jinping, which is really aimed at the upper end of the income and wealth distribution. And you raise some real questions about the desire of entrepreneurs to really invest their time and their financial capital in building dynamic new companies. And that worries me now about the longer term prospects for investing in new Chinese companies. I don't think there's a near-term problem, but I worry more about the medium to longer term issues than I have at any point since I've been following China over the last 25 years. Well, the problems are, I think, largely what I addressed, and that is really limiting the desire of young people, entrepreneurs, to start new dynamic companies. If there's going to be regulatory constraints and constraints on their income brought about through common prosperity, then it's hard to imagine a future where the energy of what we call animal spirits will be alive and provide the incentive for innovative new companies that China has been so good at developing over the last 15 years. I think there are big questions about that going forward. Well, the first thing I think about that forecast is that it's wrong, that I've made a big mistake in looking for a drop in the dollar this year. But the basic framework of the forecast, I think, still raises some very important issues that the U.S. will ultimately need to address. We have a very low domestic savings rate. By domestic, I don't mean just the personal savings rate, which is higher than it has been. But by domestic saving, I mean the personal savings rate plus the business savings rate plus the government savings rate, which is always in a deficit. In the second quarter of 2021, the domestic savings rate in net terms, adjusting for depreciation, was 1.8%. That is less than 1/3 the average level that prevailed in the final 3 decades of the 20th century. So lacking in domestic saving and wanting to grow, we have to import surplus savings from abroad, and we run massive current account deficits to attract the capital. Our current account was in deficit, equated to 3.4% of GDP by the middle of 2021. That's well in excess of what we have been running, and it's likely to get worse because the government budget deficits under the Biden administration are going to stay large for the foreseeable future and could get even larger. So the current account problem is what concerns me the most with respect to the dollar. If the Fed were to do, as I said earlier, and raise interest rates, then that would be attractive in supporting the dollar. But to the extent that the Fed is resisting that, then the currency should fall to compensate for that. And that's pretty much the case for a weaker dollar. It didn't work out this year. Doesn't mean it won't work out next year. Fair value is, sort of a mathematical calculation, but the US dollar on a broad trade weighted basis has fallen 3 times since the end of Bretton Woods in the early 1970s. It fell in the early 70s, it fell in the mid 1980s, and it fell in the early 2000s, the first decade of the 2000s. The average decline on a broad trade weighted basis, which is the number that, or the measure that I like to use, the average decline in those 3 earlier periods, again, the 70s, the 80s, and the early 2000s, was 31%. And so my call for a 35% drop reflects the fact that the imbalances today in terms of the savings and the current account problems that we spoke of a minute or two ago are worse today than they were in those 3 earlier periods. And so I still think there's the likelihood for another sharp decline in the US dollar along the lines of what we saw, if not slightly greater, in the 1970s, the 1980s, and the early 2000s. It hasn't happened yet. It doesn't mean it won't happen. Well, I wrote about that with respect to the dollar. There was a view that there was no alternative to the dollar, and I pointed out that there are a couple of alternatives worth considering, and one is the euro, which is probably the most undervalued major currency in the world and has been falling again very sharply. And I think the main problem with the euro has been the lack of a pan-regional fiscal policy to support the currency. And I think, there is a new framework that was adopted a couple of years ago, the Next Generation EU Fund, that allows for pan-European sovereign bond issuance that can fill that void. So I think that, the euro, the undervalued euro, will ultimately be an opportunity. I also continue to see further steady appreciation in the Chinese renminbi. And while I'm very skeptical about cryptocurrencies and the Bitcoin, they're now large enough so that many consider them to be an alternative to the dollar as well. I just want to underscore, I don't see the dollar losing its status as a reserve currency at any point in the foreseeable future, but I do see the dollar going through another one of these large cyclical declines along the lines of, again, what we saw in the early 70s, the mid 80s, and the early 2000s. I don't know enough to really, and I don't think anybody knows enough to frame a long-term point of view. I've been skeptical as the Bitcoin has taken off. I continue to have the belief that while you can think of the Bitcoin certainly as a new asset, you should not think of it as a new currency. And I think many investors have made that mistake in conflating sort of the blockchain technology with a new currency. And I can assure you of one thing, and that is the regulators are not going to allow a new unregulated currency to take hold in their sovereign market. So you can certainly count on regulatory involvement in cryptocurrencies, and many speculators don't allow for that possibility.